Hey friends, welcome back to my channel. If you're new here, my name is Bianca. And for those of you who may be new to the concept of real estate investment trusts, or REITs for short, well, this video is dedicated to those of you who may need a run-through of the key terminologies that's often coined in this industry. So just to recap, similar to buying an exchange-traded fund or ETF, buying a REIT is kind of equivalent to buying a portfolio of companies. So instead of buying, a portfolio of companies, you are essentially buying a portfolio of real estate. And with a different industry, there comes a different set of jargons. But once you get the gist, it should be fairly straightforward from here onwards because the investment principles are pretty similar. In this video, I'll be focusing more on the common terminologies that you are likely to come across as a REIT investor. And perhaps in the near future, I'll see if I can just run you through some of the common terms that REIT managers may come across when we are trying to buy real estate for the REIT portfolio. Now, let's walk through 10 common REIT investing terminologies. To get started, we are going to first cover a few terms that essentially evaluates the quality of the real estate/buildings that are held by the REIT. One of these terms would be the net property income, or NPI, where it is essentially the gross revenue from the property that you own minus off all property-related expenses. In essence, the main revenue stream that you as a landlord are able to charge for your property would be rent. Well, okay, technically, we do have other forms of revenue streams such as parking fees or perhaps casual leasing fees, but for most buildings, the core revenue would still be your rental income. So how would you determine that a building is a good or bad buy? Well, a lot of it is going to depend on how much rental income that building is going to be able to generate. Following that, you'll then need to deduct all property-related expenses, so it could be things like your building maintenance fee, pest control, or perhaps your electricity and water bills. However, it's important to also bear in mind that the NPI does not factor in, say, the depreciation of the real estate, the interest costs on the loans taken, taxes, or even the fund managers, or in this case the REITs, management fees. Generally, you would want your NPI to increase over time, as this indicates that your properties are able to generate more income for you as the landlord. Also, do keep in mind that the term NPI may be referred to by a different name depending on which country you're talking about. For instance, in Malaysia, where I'm based at, or Singapore, NPI is the common term used. In UK and Australia, you may see the term net operating income or NOI instead. Whilst in the US, a related concept will be this term called adjusted funds from operation, or AFFO. Moving on, we'll come across a term that my boss happens to emphasize a lot about, often, for a good reason, and that term is called the NPIU, or the Capitalisation Rate, again, depending on which country you're looking at. So the NPIU is another key metric that's used to assess the quality of the properties that the REIT is holding. And the formula for calculating your NPIU would essentially be, taking your net property income, or NPI in short, divided by the total property value. So let's break it down. Well, as how I mentioned earlier, your net property income, or NPI, is basically your property's gross revenue minus off all the property-related expenses. Meanwhile, your total property value would essentially be the current market value of all the properties that are held by the REIT. So the resulting percentage, which is essentially your NPIU, would essentially be an indication on your return on investments on those properties. And again, you would want your NPIU to be as high as possible because it implies that those properties are better quality in the sense that they're able to generate more income relative to their value. So again, it is important to also take note that different types of properties would bring different types of NPIU. For instance, an office REIT would have a different yield compared to a retail REIT. So this basically means that if you want to make a fair comparison, you will need to compare REITs that are basically investing in the same asset classes as one another. Now, let's discuss the occupancy rate, which is a key indicator of how much of the lettable space within a property is being rented out. You can basically calculate it by taking the percentage of the total rented space over the total lettable space. Typically speaking, having a high occupancy rate is usually a green flag in the sense that it signals a strong demand, effective property management, and all of which would just accumulate into, well, a steady rental revenue over time. For instance, sometimes this may mean that you as a landlord are locked into a long lease term with a fixed rental rate with the majority of the tenants, and that would thereby mean that your rental income over time is limited. In summary, while a high occupancy rate is typically a good sign, it's important to also consider some of the potential trade-offs as well. Now, one of the most rewarding aspects of investing in a REIT is the regular income that you receive, known as distributions per unit, or DPU. Just to recap, in REIT investing, distributions is the same as dividends, whilst units are the same as shares. So as the name implies, DPU essentially measures the amount of distribution that you receive for every unit that you own as an investor. And this ultimately gives you a good assessment of the income that you are able to get as a REIT investor. Distributions are typically paid on a quarterly or half-yearly basis depending on the REIT's policy. Naturally, as a REIT investor, you would want your DPU to increase over time again because it implies that the REIT is capable of paying more distributions for every share, or in this case, unit that you own. And this ultimately is a clear sign of growth as well as rising profitability in the underlying properties. Other than that, there's also this term called the distribution yield, which is pretty important if you want to assess the income potential of a REIT investment. You can kind of think of the term distribution yield to be equivalent to the term dividend yield when it comes to stock investing. And you calculate it by taking the distributions per unit, or DPU, and divide it by the current market price of the REIT unit. As you can see, this formula essentially tells you the amount of distribution that you're getting relative to the price that you're paying for that unit. And well, for the long-term success of your investment, you would want your DPU as well as the REIT unit price to increase over time. But in a very ideal sense, it will be great for your DPU to increase at a faster rate as opposed to the market price for the unit, because it shows that your distribution yield can remain attractive over time. Having said all that, it's pretty crucial to also remember that your distribution yield can fluctuate constantly because, well, your unit price can fluctuate constantly. Moving on, we have the net asset value, or NAV, which is important for us to determine the underlying value of the REIT's assets after accounting for all of its liabilities and obligations. Well, calculating it is also pretty straightforward. Well, you just take the total value of all the REIT's assets minus the total value of all of its liabilities. Meanwhile, the NAV per unit would take this a step further by essentially taking the net asset value, or NAV, dividing it by the total number of units that's issued by the REIT. In simple terms, this metric gives you a value as to how much this unit is worth if the REIT were to liquidate all of its assets, pay off all of its debts and obligations, and then distribute the remaining funds back to its investors. Oh, again, one other thing. The calculation of your NAV, or net asset value, is again dependent on which accounting standard you are applying. If you happen to be adopting the IFRS, or the International Financial Reporting Standards, which is commonly used in Singapore or say the UK, then your total property value will be basically the current market value of those properties. On the flip side, if you happen to be based in the US and therefore you're adopting the GAAP, or Generally Accepted Accounting Principles, then you will be taking your property value as the historical cost of those properties adjusted for depreciation. So again, if I were to wear my REIT investor's thinking cap, I would say it would be a great opportunity to buy if I ever see a REIT unit price being below the NAV per unit. Because if you think about it, it implies that the value of the REIT is now priced below its intrinsic value, meaning to say that you are essentially buying the REIT units at a discount. Now, we are talking about price, so let's move on to talk about the price-to-NAV ratio, which is a pretty crucial metric if you want to determine if the REIT unit price is selling well at a fair rate, or if it's basically undervalued or overvalued. And you calculate it by taking the current REIT unit price divided by the NAV per unit. Similarly, as an investor, I would love for this ratio to be as low as possible. And that's because a ratio under 1 would then imply that the REIT is undervalued, meaning to say that you're buying the assets for less than what it's actually worth. Now, to shift gears a bit, as an investor, it's also important for you to assess the financial strength of a REIT before investing. And part of it will involve looking at the gearing ratio, which is also known as the debt ratio or the leverage ratio. As its name suggests, this ratio essentially tells you how much debt a REIT has taken up to acquire its properties. Usually, a REIT would finance its purchase of properties through a combination of both equity and debt. So the debt part can come in a form of, say, taking a loan from the bank or perhaps issuing bonds to the public, both of which would require the REIT to pay interest. And when you're assessing the gearing ratio, you essentially take the total debts and divide it by the total assets. So what does the gearing ratio mean? Well, having a high gearing ratio would essentially imply a higher financial risk because the REIT has taken a lot more debt to finance its purchase. Generally speaking, REITs with a high gearing ratio tend to be more vulnerable during economic downturns or, say, periods with a high interest rate. Well, if you know, you know. And that's because, well, no matter what the situation is, you're still obligated to service your debts. Hence, if you happen to be an investor who's looking for a more stable and resilient REIT, well, you have to find one with a low or healthy gearing ratio. On top of that, when a REIT borrows money to finance its purchase of properties, it's also really important for you to consider the cost of debt. So think of the cost of debt as the effective interest rate that the REIT pays for all the borrowed money. Ideally, you will want this cost of debt to be as low as possible because, well, the lower the cost, the more profits you can gain as a unit holder. Last but not least, we have the interest coverage ratio, which is a way for you to determine whether the REIT is capable of managing its interest expenses. And well, you can calculate it using a simple formula, which is basically taking the EBITDA, or the earnings before interest, taxes, depreciation, and amortization, and then divide it over the interest expenses. Overall, you will want your interest coverage ratio to be as high as possible because it indicates that the REIT is earning a lot more than what it needs to pay off its debt obligations. For instance, if your interest coverage ratio is 5, that would mean that your REIT is earning 5 times more than what it needs to pay off its interest expenses. Therefore, it substantially lowers the risk of any financial strain. With that, thank you so much for taking the time to watch my video. If you found it to be helpful, do consider hitting the like, subscribe, and bell icon. In the meantime, if you need a quick refresher on the concept of real estate investment trusts or REITs, well, I've made a video just to guide you through that, so do check it out. Till then, have a pleasant day ahead, and I shall see you in my next video. Bye bye!